I welcome you all to a new webinar of Proficient Group, and this is 16th of June today. And today we are going to talk about volatility index, which is commonly called as India VIX. First of all, I'm showing you a chart of India VIX. This is the chart of India VIX, and the chart is pretty much complicated and very much confusing, as you can see, highs and lows, but overall there is no trend and all those things, and it is really difficult to interpret anything from this chart. And we also do not know what the entire thing is, what the entire India VIX mean for us, right? What does it tell us? Is it really helpful in our trading? All those things are not properly understood in the context of volatility. So today we are going to talk about volatility, and we are going to see how this index called volatility index, India VIX, can help us in our trading. Let me tell you that what do we mean by volatility, first of all. Volatility is one of the components in price action. There are three other components. First is trend, right? The trend means directional movement of price, and we have many indicators to cover the direction of the trend, whether it is uptrend, downtrend, or choppy trend, all those things. So, and also there is a trend possible in all time frames, right? In hourly chart, in daily chart, weekly chart, quarterly chart, all time frames there is trend. So trend is the most important component of price action. The second is cyclicality, right? Cyclicality means periodic upward and followed by downward movement, right? Stocks move in cyclical nature. Most of the stocks move in cyclical nature, and there are various techniques to find out cyclicality, and if time permits we will later talk about cyclicality. The third component is seasonality, right? Seasonality means it is also a sort of cyclicality, but its time period is 1 year. That means how the stock performs with respect to the seasonality. That means with respect to monthly variation. Suppose we can see, suppose there are FMCG stocks, right? FMCG stocks generally see some upward movement or buying activity during the monsoon season or pre-monsoon season, all those things like that. Because with good rain, the overall income of the people rises, and they spend more on consumer goods, and all this logic comes into play. And these things are applicable, these logics are applicable into various sectors. Mostly seasonality is seen in agricultural stocks and agricultural commodities, but it can be extended to many other products, even gold or crude oil, and many other stocks like airlines stocks. Those see good kind of buying, good kind of demand during holiday seasons. These are all called seasonality, and we have various techniques in our arsenal to find seasonality. The fourth component is volatility, right? And volatility means there are various definitions of volatility. In a broader sense, I can tell you, volatility means net change in prices in a given period of time, right? Net change in prices. So the price may go up in a certain period. Suppose it is we're talking about one day. So in a single day, prices may go up and then it may come down. So net change in one day may be negligible, but since there is a huge amount of high and huge amount of buying activity and then huge amount of selling activity, we will generally say the volatility is on the higher side. There is some complicated definition of volatility. I am not getting into that aspect. So we will remain into the practical aspects of volatility. And so that is those are the four components of prices: trend, cyclicality, then seasonality, and finally volatility. And if there is anything in price that cannot be explained by these four components, then it will be called noise, right? So mainly there are these four components of prices, and today we will be talking about volatility. India VIX is the index of volatility, and I'm talking about. I'll come to India VIX later, but in order to make sense about what India VIX is all about, I have to start today with a little different topic, and then I will come to the volatility aspect. Today, I'll first cover a conception called put to call parity, right? Put to call parity. What do we mean by put to call parity? This conception is very important to understand volatility. Put to call parity means suppose we have an at the price strike. Suppose our stock price is at 50 rupees 50, and 50 strike call and 50 strike put. That is we are talking about. Now these two options are actually tied in a fundamental relationship, and their prices cannot move. One of the options, price of one of these options cannot move at random, and the other option cannot remain standstill. If there is something happening into the price, then both the option price has to move accordingly, right? That is what is about what is put to call parity is all about. Now let me give you an example. Suppose we are talking about a stock, and let the name of the stock be ABC Corporation, right? And ABC Corporation is right now trading at rupees 50, and we are talking about 50 strike call, and suppose the 50 strike call is trading at rupees 2, right? Price in rupees. And let us also take another 50 rupee strike put, and let us assume ideally it should also trade at rupees 2, right? And I'm right now telling you why that is the case, and that is what put to call parity is all about. But actually, if for some reason, suppose the put is not trading at rupees 2 and it is trading at something else, suppose the 50 strike put is trading at rupees 1.50, then I'm telling you this cannot happen, right? This is the price of put that cannot exist in reality, because if that is the case, it will give us some some riskless profit. Some arbitrageurs will come and they will take this opportunity as a risk-free profit opportunity, and they will get profit out of the situation. So this situation cannot exist for long enough. Let me tell you why. If something of this occurs, let me tell you, buying a future and buying a put is equivalent to buying a call, right? So in this case, let us assume we are taking a trade. Suppose we see this kind of opportunity that the at the price call is trading at ₹2 and at the price put is trading at ₹1.5, then we have some risk-free profit opportunity. Let me tell you why. If such situation occurs, then we will just buy the future at ₹50, and we will also buy the put at ₹1.5, right? And we will sell the ₹50 strike call at ₹2, right? And if we can do all these things, then there is a guarantee that we will get 50 paise profit from this position. Let me tell you why. Suppose the stock price suppose the stock price goes to ₹60, right? So if suppose these are our entry prices and these will be our exit prices. Suppose so these are our entry prices and these will be our exit prices. So if the stock price goes to 60, so we will have some 10 rupee profit from the stock, and our call we will have to exit from the call at -10 and the 50 rupee and the 50 strike put will be worth 0, right? So what will be our profit loss scenario in this case? What will be our profit loss scenario in this case? From the call, from the future, we will get a profit of ₹10, right? Because we bought it at ₹50 and we are selling it at ₹60. So from the future, we are getting a profit of ₹10. From the call, we are having a loss of ₹8, right? Because we sold it at ₹10 and we are having to buy it at we sold it at ₹2 and we are having to buy it at ₹10. So we are having a loss of ₹8. And from the put, we are also getting a loss of ₹1.50. So net, we are having a profit of so net we are having a profit of ₹0.50. This is the riskless profit that we are having, right? So if stock prices rises, we are having a profit of ₹0.50. What will happen if stock price falls? let us take another situation where actually stock price is falling, right? So let us assume the stock actually went to rupees 40, right? In that case, we will have to exit the call at rupees 0, and we will get some 10 rupees from this put, right? So we are getting some 10 rupees from this put. So what will be our profit loss scenario in this case? In this case, we were taking a loss of 10 rupees from the future. The call that we sold at rupees 2 is giving us a profit of rupees 2, and the put that we bought at 1.50, right? We are getting a profit of 8.50 because we are having 10 rupee from this put, but we had to buy this put at rupees 1.50. So we are getting a net profit of rupees 8.5 from this put. So again, net we are having profit of 0.50, that is a 50% profit. So in whichever direction the price goes, the price may rise or the price may fall. In whichever direction the price goes, we are actually locking in a profit of 0.5 paise. And this 0.5 paise was actually the difference of the prices of this call and put, right? So if there is a big difference in the at-the-money strike call and put, so that will give us a riskless profit opportunity. And if that be the case, then arbitrageurs will step in, and they will take opportunity of this situation. That means they will take this kind of trade and they will lock in their profit. They will sell the call, so the price of the call will come down, and so they will buy the put, so the price of the put will go up, and so the difference that is right now 0.5 rupees will diminish, and this profit opportunity, that is the riskless profit opportunity, will actually vanish. So this is called the put to call parity, which means that at the price strike put and at the price strike call are the price of these two options are tied to each other by means of this fundamental relationship called put to call parity. If the price of the call rises, the price of the put has to rise. Otherwise, there we will get some arbitraging opportunity, which is riskless profit opportunity. One thing I have to say here, that during this at this profit, we have to also give some trading costs, some brokerage, some government taxes, and all those things. So real profit will be less than this, and that is the actual scenario. That is what happens in reality. Although there is some difference, always there is some difference between at the strike call and at the strike put prices, but the difference is not so much that even if we can do this kind of trading, we can incur profit after paying all the taxes and all the fees. So, but if the difference increases by any means, and we have to be very vigilant about it, we can create software to see if certain inefficiencies, these are called market inefficiencies. If we can spot certain inefficiencies in the market, then we can enter in this kind of trade. So this is all about put to call parity. And why I told you about put to call parity is to understand volatility and to understand the VIX index, we have to understand the put to call parity, right? Now let us come about the India VIX, right? So put to call parity, what taught us? It only taught us that at the strike, at the money put and calls has to has to have some fundamental relationship among them. The prices of them, the prices of at the money strike, call, and put has to be nearly equal, if not exactly equal, right? Otherwise, arbitrators will come in and they will take advantage of the situation. Now, having said that, let us go to the India VIX indicator. Now, what is India VIX indicator? Many a times when prices fall suddenly and there is a little bit of panic in the market, we can see on television and on media that India VIX has suddenly rises to that much extent, and it has risen 10% or 20% or sometimes even 30 or 40% and all those things. So what do we mean by India VIX and how we can take advantage of that kind of situation? That is the topic of today's session. Now, VIX, which stands for Volatility Index, is actually a proprietary indicator of Chicago Board of Trade Exchange. This index was actually started by them way back in 1990s. And what is the basic conception? The exact calculation technique is not revealed by them. NSE has only taken a license from Chicago Board of Trade to use their technique into the Indian market to give Indian traders a perspective of volatility. In Chicago or in US, you can also trade VIX volatility index, and that is a very legitimate way of hedging your portfolio. And there are lots of strategies to trade India VIX to hedge your portfolio. Back home in India, we do not have such a trading. We cannot trade India VIX as yet, but hope in near future we will also be able to trade India VIX. There will be contracts available for VIX. And before that happens, we need to learn about VIX. So how Chicago Board of Exchange actually calculates VIX, their trademark index, is not exactly disclosed. We do not exactly know what is their specific calculation technique, but we do know certain principles that they follow in the calculation. And what is that? They just measure the volatility of the index options, right? Suppose our index is Nifty, and we are trading Nifty, and there are options available on Nifty. So VIX is calculated by taking into account all the calls and all the puts, those are available. Much more weightage is given to the out of the money calls and out of the money puts, and how their volatility is changing, right? How the option volatility is changing. That is the underlying principle of VIX. That is the underlying principle of volatility index. Now, here is an important conception. When prices rise, there is not much change in volatility index, right? Because when prices rise, people become very happy. People become very content and confident. They show confidence, right? So that is when volatility index shows a low value, right? Volatility index shows a low value when prices rise. But volatility index suddenly rises when there is a panic sell, right? When there is a panic sell, what happens? People are suddenly caught off their guard and they have a large portfolio. Mostly their portfolios are over leveraged, so they are suddenly having a lot of loss. And to cover their losses, they will now buy puts, right? They will now buy puts to cover their uh, cover the losses or to cover their risk in their long portfolio. They will buy puts. So when puts are being bought at a certain price, most of these puts are generally bought in at the value strike price. Due to the put to call parity, the price of the calls are also rising, right? And this is happening in spite of the market falling. This falling price of the call is solely because of their rise in volatility. So yeah, I'm not telling the rise in call in absolute term, but there is a component of volatility in every strike price, and it is that volatility that is causing uh, the competitive rise in call price. Rise means whatever should be the magnitude of fall in call prices because of a fall in prices in stock price. The call is not falling by that extent. So that is what is I'm referring to as a rise in pricing call. And this is all happening because of rise in volatility. So when there is a sudden fall in prices, uh, the volatility index VIX shows a spike. Let me show you the uh, February prices here in VIX on 1st of February. VIX closed at 14.10, and on the following 3 days VIX went to 20, right? So this is a 50% rise in VIX in only 3 days. Why this thing happened? Let me show you what Nifty did in those days, right? This is what Nifty was at 1st of February. In 1st of February, Nifty was at 11,016, and in the following 3 days, Nifty was at 10,500. So there is a 600-point fall in Nifty, which is around 6% fall in Nifty in 3 days. So this is a huge sell-off. We can all remember this sell-off in Nifty. People went in panic, right? People made losses, people incurred losses. They were having lots of leveraged position. And forget not what happened in January. Prices rose hugely in January, and after that huge rise, prices fall 6% in only 3 days. So this is how the volatility index rose 50% in these 2 days, and it showed a price of 20 from 14 in only 3 days. So this is a rise in volatility index. Why this thing happened? Because naturally people started to buy puts, and because there is a lot of demand in puts, the price of the puts went higher. If price of the puts went higher, then the price of the call has to go higher because of the parity, right? Because of the put to call parity. Otherwise, there would have been risk-free profit opportunity, and that cannot exist in an efficient market. So this is how the VIX actually behaves. We can take advantage of these short-term spike in volatility, we can create trading strategy in VIX. But since VIX cannot be traded in India, there is no point in talking about that as of now, at least. But here, I want to give you an important trading strategy in Nifty from VIX. And this, I think, will give you a very insightful food of thought, food for your brain, and you can create a complete trading strategy of your own from this VIX. What I'm going to tell you is that from the value of the VIX, right? From the value of the VIX, you can create an option trading strategy in Nifty, and you can create a rise. You can create a range in Nifty that is most likely to be honored by the index in the next one session, or in the next 5 trading session, that is next 1 day, or in the next 5 days, or even in the next 1 week, right? So what I'm going to tell you is that suppose Nifty is trading at 10,870, right? So we are going to create a range in the upward and downward of this price, and Nifty is most likely to stay within this range for the next 1 week. If that is the case, then we can create a strangle selling strategy that we can create a strategy to sell a call option of the higher strike price and sell a put option in the lower strike price, right? That is called strangle, selling a strangle. But which strike price to choose from, right? That idea we will get from VIX. So let us do some little arithmetic. Last week's close in VIX was VIX closing was 12.07, right? So last week's close was 12.07 in VIX. Yeah, it was Friday's close. So we can, what do we do with this? We are going to create a trading range in Nifty for the next 1 week. 1 week is our trading horizon. So there are 52 weeks in an year. So in this case, we will create a time period which is 52 weeks, and we will take square root of that time period. So square root of time period, square root of 52 is 7.211. Square root of time period is 7.211. Now, all we will do is to calculate the percentage change in Nifty, which is the probable percentage change. Probable percentage change in Nifty in next one time period. For us, this next one time period is actually 1 week. So what is the probable percentage change in Nifty? We will just divide the value of VIX with the square root of the time period. So we are getting 1.67, and this is the probable percentage change in Nifty in next 1 week. This level, this value we are getting absolutely from VIX. If the value of VIX were very high, suppose 20, then naturally this will give us a higher probable value of percentage change in Nifty. So Nifty is more likely to change in terms of percentage value. If we get a very low value in VIX, then probability of Nifty for a big change will fall. So this value will give us what is the probable percentage change in Nifty next 1 year. This is nothing but we are dividing the value of VIX with the square root of the time period, right? Suppose we are not interested in 1 week. Suppose we are interested in 1 day. Only we are interested in Monday. So how many days are there in a year? There are 252 days in a year. So square root of 252 days is 15.87. 252 is 15.87, and that will give us a probable percentage change in Nifty for the next 1 day. That is for the next Monday is 0.76%, right? And this percentage change is possible in both upside and downside. What is the probability? The probability is 67%. That is the one standard deviation. I'm coming back to this conception later, but let us keep the values for 1 week and give you one complete solution. The value was 52. We are going to calculate the probable movement in Nifty for 1 week. So what is the possibility? Last week's closing in Nifty, that is 10,817, right? So that is 10,817. So 1.67% to the upside of this value and 1.67% to the downside of the value. That is the probable range of Nifty, upper range of Nifty, upper range for next week and lower range for next week. So what will be the upper range? So this value equal to this value multiplied by 1.0167. So that is 1.67% higher, and the value comes to be 10,997, right? So 10,997 is the probable upward range for Nifty next week. What is the lower range for Nifty next week? the lower range for Nifty next week will be this value multiplied by 100 minus this divided by 100. So the lower range is possible at 10,635. So these two values we are getting from the value of VIX. That means Nifty, there is a 67% probability, right? Why this is 67% probability? That is how VIX is calculated. It will give us a one standard deviation of probability, that is 66 to 67%, two-thirds of the probability that Nifty will lie between 10,997 and 10,635 next week. So 10,997. 10,997 is the upward range for Nifty next week, and 10,635. 10,635 is the lower range of Nifty. Possible, highly possible. Two-thirds is the possibility, that is one standard deviation. And these values we are getting from VIX. Naturally, if the value of VIX is high, very high, if the value of VIX were some 20, then all these values will rise, right? I did not put any formula here, so this is not showing any change. But if the value of Nifty is rising, so let me put the formula here, equal to this multiplied by this plus 100 whole divided by 100. So this value is now changing. 12.07, that was the original, yeah, 12.07, that was the original. 10,998, that is the higher range, and 10,635, that is the lower range. Within this range, there is a 67% probability that Nifty will lie next Friday on a closing basis, right? Now let's see if the value rises heavily. If the value is some 20, then definitely these values are also, the upper range is also rising and the lower range is also declining. So the range is actually rising, and we will have to sell higher value options and lower value put options, higher value call options and lower value put options. And if the value is less, right, say if the value is 9, then the upper range is also coming low and the lower range is also going higher, as you can see. So this is how the VIX, India VIX, right, can give us a probable range of Nifty in the next one session. This I told you about 1 week, but you can also use the same calculation for 1 month or 1 week. If we are using 1 month, then how many months are there in a year? So there are 12 months, right? So there are 12 months. So the square root of 12 is 3.46, and probable percentage change in Nifty in the next one time period means 1 month. It will be 3.48%. Last closing, let me change it. Latest closing in Nifty. Latest closing in Nifty is 10,870. So in spite of the VIX value not rising since the time period is declining and the square root of time period is rising here, square root of time period. So we are getting upper range at a higher value and lower range also at a lower value. So since we are allowing much more time, so the range is rising like this. So this is how we can use volatility index for our trading purpose. I'm coming back to our original time frame. Yeah, I'm coming back to our original time frame, which is 1 week. So these two levels we are getting from India VIX, and here we have plotted these two values. There is only 67% probabilities. I'm not telling that every day or every time 100% cases this will be true. This will be true only 67% of the cases. So you have to uh, do some risk management according to that. But the strategy tells us that you can sell a call of 10,000 or suppose 11,000 call is safe to sell, and 10,600 put is safe to sell for the next 1 week, right? Now, that does not mean you will sell and will not take any risk management measures. You will definitely have some risk management measures, and that will actually cover your that will actually be defined by your entire trading strategy, right? So that is a different story altogether. Right now I only told you how you can use VIX to India VIX index to get a legitimate idea about the next week's range in Nifty. And before we end, I can also tell you that there is many other volatility indexes. There are volatility indexes for crude oil, which is called OVX, Oil Volatility Index, right? You can take advantage of that volatility index to gauge the next week's oil range, crude oil range. And you can also trade the options in crude oil. The crude oil options right now are trading in our own Indian MCX exchange. So you can do that. There is a volatility index in gold as well, gold volatility index, right? You can also take that advantage of volatility index in gold to gauge the next week's probable range in gold, and you can also do some strangle or selling to take advantage. So there are different opportunities lying there, but you have to create a complete trading strategy. That is what I am recommending you strongly, with proper risk management, because sometimes there will be huge movement and you have to be able to take care of that risk. So that's what I intended to cover in this webinar. I hope you liked it. This video will be posted in YouTube, and we will welcome your comments if any, and if there is any problem that you face, you can also ask me there, and I'll be very happy to reply to your problems. And I thank you all for viewing this webinar. I hope you enjoyed it, and see you next week with a new topic. Thank you.